On the 1st of March 2021, one of the world's most respected banks pulled the plug. Credit Suisse froze 4 investment funds holding roughly $10 billion of its clients' money. The funds had been sold as boringly safe, short-term, insured, low risk. Within a week, the company at the center of it all filed for insolvency. Within days, a bank in Germany was shut down by regulators. The shockwaves reached a former British Prime Minister, thousands of steelworkers, and a string of small German towns that had quietly parked their cash in what looked like a sure thing. The firm was called Greensill Capital, and its entire empire rested on something most people never thought to question: an insurance policy that could be cancelled. This is the story of how a financier built a billion-dollar business on one of the dullest products in finance, paying suppliers early, and turned it into a fragile tower of hidden debt, concentrated risk, and circular money. It's a story about how complexity can disguise danger, and how a thing marketed as safe can be the most dangerous thing of all. To understand why it collapsed, you have to understand how it was supposed to work, and why so many smart, careful people believed in it. In 2011, an Australian financier named Lex Greensill founded Greensill Capital in London. His specialty was supply chain finance, also known as reverse factoring. The idea is genuinely useful. Imagine a big company that owes its suppliers money but doesn't want to pay for 90 days. The suppliers want their cash now. Greensill stepped into the middle. It paid the suppliers early at a small discount, then collected the full amount from the big company later. To fund all this, Greensill bundled those short-term debts, the receivables, into bond-like notes and sold them to outside investors. The biggest buyers were Credit Suisse, through 4 supply chain finance funds holding around $10 billion, and Greensill's own bank in the German city of Bremen. The pitch was elegant. These notes were short-term, they paid more than cash sitting idle, and, crucially, they were backed by trade credit insurance. If a borrower failed to pay, the insurer would cover the loss. Safe, in other words. The story attracted serious money. In 2019, SoftBank's Vision Fund, the giant Japanese investment vehicle led by Masayoshi Son, poured roughly $1.5 billion into Greensill. Turning it into a fintech unicorn, Greensill hired prestige advisors, including former UK Prime Minister David Cameron. From the outside, it looked like the future of finance, technology smoothing the plumbing of global trade. More than 1,200 wealthy clients invested through the Credit Suisse funds, reassured that their money was parked somewhere dependable. Mid-roll. But beneath the polished surface sat 2 fatal flaws. The first was concentration. A financial product is only as safe as the borrowers behind it, and a huge slice of Greensill's lending, roughly $5 billion, was tied to a single borrower, the GFG Alliance, the metals and steel empire run by industrialist Sanjeev Gupta. Worse, according to administrators and later reporting, some of this lending wasn't backed by existing invoices at all. It involved so-called future receivables, financing based on projected future sales rather than sales that had already happened. Investigators flagged the inherent risk. Those projected sales might never materialize. That's a long way from the safe, short-term trade debt investors thought they were buying. The second flaw was the keystone of the whole structure: insurance. The notes were marketed as low risk because they were insured. But that insurance was cancelable. The most critical cover came from a single underwriter at Tokyo Marine's bond and credit company. Pull that one policy, and the notes would lose the very feature that made them sellable. There was also a tangle of circular money. SoftBank funded Greensill. Greensill, in turn, financed companies that SoftBank had backed. And SoftBank also put money into the very Credit Suisse funds that bought Greensill's notes. Money flowed in a loop, flattering everyone inside it. And concern had been building for years. As early as 2017 and 2018, the asset manager GAM was rocked by a scandal when its star fund manager Tim Haywood was suspended over Greensill-linked deals, sparking a run on his funds. He was later dismissed and fined by regulators. The warning signs were there for anyone willing to look. Then, in July 2020, the keystone moved. The underwriter at Bond and Credit Company, who had signed off on much of Greensill's cover, was fired, reportedly for exceeding his authority. Soon after, Tokyo Marine's insurer decided not to renew Greensill's credit insurance. The single thread holding the structure together was being pulled. When the insurer declined to renew, Greensill scrambled for replacement cover. It couldn't find any. Without insurance, the notes could no longer be sold as safe. The fragile logic that held everything up simply dissolved. By late 2020, SoftBank had written down its roughly $1.5 billion stake. Germany's financial regulator BaFin was growing alarmed at how much of Greensill Bank's lending was concentrated in Gupta's empire. The unraveling came fast. On the 1st of March 2021, Credit Suisse froze its 4 supply chain finance funds, about $10 billion, citing uncertainty over the value of the assets inside them. The same day, GAM closed its own Greensill-linked fund. 2 days later, on the 3rd of March, BaFin imposed a moratorium on Greensill Bank and filed a criminal complaint with prosecutors in Bremen over suspected balance sheet manipulation. On the 8th of March, Greensill Capital's UK arm entered administration. The next day, the Australian parent company followed. A business once valued in the billions had collapsed in a matter of days. And the fallout spread far beyond wealthy investors. More than 50 German municipalities had deposited at least $600 million with Greensill Bank, money that was largely unprotected by deposit guarantees. In Britain, around 5,000 jobs were put at risk at Liberty Steel and other GFG-linked firms, threatening industrial towns like Rotherham and Stocksbridge. UK taxpayers were exposed to more than £1 billion through government-backed loan guarantees, and the damage reached the very top of British politics. David Cameron, the former Prime Minister, had personally lobbied government ministers on Greensill's behalf, sending dozens of texts and messages. A parliamentary inquiry later concluded he had shown a significant lack of judgment, though it found he had broken no rules. Mid-roll, the reckoning continued for years. In 2022, the UK Serious Fraud Office opened a criminal investigation into Gupta's GFG alliance over suspected fraud, fraudulent trading and money laundering, allegations the group has denied, and the matter remains under investigation. Switzerland's regulator FINMA found that Credit Suisse had seriously breached its supervisory obligations, and Greensill was one of the blows that helped bring down the 167-year-old bank before its rescue by UBS. Lex Greensill himself accepted a 9-year ban as a company director, after a London court sharply criticised him for concealing his firm's true position. So what does Greensill actually teach us? The first lesson is that safe is a marketing word, not a guarantee. A product can be sold as boringly low risk while hiding enormous fragility underneath, through complexity, concentration, circular funding, and conflicts of interest. The more layers between you and the actual borrower, the harder it is to see the danger. The second lesson is that hidden debt is still debt. Supply chain finance can quietly flatter a company's books, dressing up borrowing as ordinary trade payables. It can make a balance sheet look healthier than it is, right up until the moment it doesn't. After the collapse, accounting bodies introduced new global disclosure rules for supply chain finance. Precisely so, this kind of borrowing can no longer hide in plain sight. And the third lesson is about single points of failure. When an entire structure depends on one cancelable insurance policy and one dominant borrower, you don't have a diversified business, you have a row of dominoes. The failure of one link froze billions and reached people who never knew their fortunes were tied to it. German towns, British steelworkers, taxpayers. Risk doesn't disappear because someone calls it safe. It just hides, waiting for the one thread that, when pulled, brings the whole thing down. Greensill was a house built on insurance, and when the insurer walked away, the house had nothing left to stand on. The most dangerous risks are often the ones wearing the word safe. Next time, another story of how the money really moved, and who was left holding the loss.